Gold's rally keeps on running. It is up almost 7% so far this year, hitting a record high again today. But it wasn't until recently that gold miners got in on the rally, the GDX ETF bouncing back this month. So could it be a golden opportunity? Let's bring in Michael Bapis with Vios Advisors at Rockefeller Global Family Office. Michael, great to see you. So, we like to play a game, Would You Rather here. So would you rather gold or gold miners? Because it gets at this question of the underperformance that we have seen until very recently of the gold miners.
Yeah, it's an interesting time right now. I mean, thank you for having me. Markets at our all-time highs right now, and it doesn't even feel like that. And so I think that's part of the reason why a lot of these hedge assets haven't moved very much. And you're seeing alts, sort of get returns, but everybody's focused on the small subset of companies that are driving all these markets higher. If you look at an equal weighted versus a cap weighted rate of return, it's about 50% equal weighted on the S&P 500 in 23 and so far in 24. So we're seeing that the hedged assets always a good part of the portfolio and important to the allocation. But at the same time, no one's paying attention to it. And that's probably why you're seeing them struggle as they have.
So gold or gold miners?
Look, I think gold is more of a hedge. Gold miners is more of an investment. And so we add gold as a hedge to many portfolios, and I think I would pick that one over the miners just because it fits into more of an allocation model rather than just picking individual securities and individual drillers who mine the gold.
Michael, hey, it's Tim. Thanks for joining us. You made a point on the market's moved, but really a lot of the market hasn't moved, and I'm curious. I think, if anything, right now, I'm happy to say that I think a lot of the sectors that were underperforming 2 years that I owned and felt pretty silly about have actually moved a lot. I mean, right. Airlines, Delta's up 50% over, kind of the last 60 trading sessions. Citibank's up 63%. Industrials are at all-time highs. I think the list goes on and on for real economy stuff. And I guess the question I have for you is, do you think that stuff is run too far? Because I think that's really the question. We all know the Nasdaq's had a big move.
Thanks for having me, Tim, and thanks for the question. I don't think it has. Look, earnings are strong right now. And if you look at inflation has slowly started to come down. You're most likely going to see rates come down sometime soon. So at this point, you want to be in anything but cash. And as rates come down, as these consumer and all these other real life names continue to grow, you're going to want dividends from them. And they're the ones that pay dividends. They're the ones that are growing their earnings. They're the ones that continue to grow cash flow, grow earnings. And while you say that, a lot of people don't even focus on it right now. And so it's just such a tech heavy Nasdaq focused move. I really believe that these other not this, I wouldn't even call them laggards, just these other companies that no one's paying attention to, who, like you said, have outperformed some of them. They have more room to grow. I mean, we're pretty cautiously optimistic, assuming nothing crazy happens in the world or with the election. I mean, I think, elections have been around for many years and somebody's going to get voted in the first Tuesday in November. And we'll move past that. It's more important to look at the earnings growth and look at, where's the consumer spending their money? Where are they buying and where's the buying power coming from for all these companies?
Michael, in the precious metal space, as we've established, gold's at an all-time high. Silver's 50%, 50, half of its prior all-time high. Do you think there's a catch-up trade there? I know a lot of people believe that.
There possibly may be, but I like to just get a basket of these securities, get a basket of these hedges where instead of just picking one trade and possibly being right, possibly being wrong, diversify the hedged assets and the alternative investments to where they become a part of the portfolio and you're in this for 3, 5, 7 years because, we all know when the markets do get choppy and when rates assume they fall, a lot of times the metals outperform, especially in that kind of a rate environment. And we're most likely going to see it coming soon, whether it's, mid-year or end of year.
Michael, thanks. Good to see you. Michael Bapis.
Thanks, Melissa. I appreciate it. Thank you all.